Town Bank Mortgage, NMLS number 512138, is an equal housing lender. This podcast is for informational purposes only. And now, the man born with a 5 o'clock shadow and with the NMLS number 2028201. He is a gentleman. He is a scholar. He is
Tyler Crawley.
Well, this is going to be a fun show. Not just because rates fell. That's always a fun show. But it's my only show of the week. I will not be doing another show. So we gotta get everything in this week into this one show, which is going to be kind of hard because it's jobs week. It's an early jobs week. You know, sometimes when you have a kind of hybrid week where it's, you know, the ending of March, beginning of April, sometimes they'll push that jobs week. So it's kind of late. But this is kind of an early jobs week. So we will be getting jobs data this week. We'll be talking about that. But welcome, everyone, to the Tuesday edition of Wilmington Mortgage. I am the aforementioned host of this podcast, Tyler Crawley, of course, loan officer, Town Bank Mortgage, right here in Wilmington, North Carolina. And what we do is break down the top stories impacting mortgage rates, both yesterday and then what could impact rates today is sort of what we're doing here. So it was a great day for rates. Very happy. Just awesome. When you see the 10-year down at one point, almost 11 basis points. It wrapped up right around 8-9 basis points. So, which was great because it was pretty much the exact opposite of what we saw on Friday when I think the 10-year jumped about 10 or 11 basis points. So we got a reversal on Monday and some reasoning behind that, not just, you know, optimism. Last 2 weeks or really the last month since the conflict in Iran began, it's been this sort of back and forth about, well, there's optimism today about Iran, pessimism. You know, so when you have optimism, rates fall. When you have pessimism, rates rise. And so we've been going back and forth. But today we actually got comments from the Fed Chair, Jerome Powell, about the Iran conflict. So it's still kind of about the war in the Middle East, but it was actually because of what Powell had to say. So we're going to talk about that. But like I said, it was a good day. So we had the 10-year was down to about 4.35%, down around 8 or 9 basis points. The Mortgage News Daily 30-year fixed rate index was down about 9 basis points to 6.55%. So all in all, a pretty great day that we saw that movement in rates for both the 10-year, the 30-year, all that good stuff. Pretty happy about that. And one of the main reasons why Bloomberg reported that traders, bond traders, are now more focused on a possible rate cut because of the comments that Powell made today at the end of the year, and are sort of, you know, one of the reasons that we saw rates rise is that traders were thinking there's going to be a rate increase because we saw that with some of the European, I almost said more European central banks, the European central banks, the European Central Bank, and of course the Bank of England, both signaled pretty heavily that rate hikes were more likely than rate cuts. And the reasoning was the price shocks being caused by what's happening in the Middle East. And Powell addressed that today. He was speaking to students at Harvard, and he basically said that the long-term impacts have remained steady and that there's been no real change. It's more of the short-term issues. And when it comes to the Fed, that's what the Fed is more concerned about. Powell said to the students at Harvard, you can have a series of these supply shocks, and that can lead the public generally, businesses, price setters, households, to start expecting higher inflation over time. Why wouldn't they? And so his argument is if you have sort of a short-term shock, then it's not really a problem. It's when it sort of starts impacting long-term expectation from consumers, then that's when businesses can start adjusting their prices, and that's when you actually get the inflation. Nick Timmeros over at the Wall Street Journal wrote, talking about Powell's speech, saying the dilemma for the Fed is that an energy shock can simultaneously push prices higher and drag down economic growth by squeezing household budgets and raising costs for businesses. That leaves policymakers weighing whether to give priority to fighting inflation or cushioning the economy. Powell said, quote, "We will eventually maybe face the question of what to do here. We're not really facing it yet because we don't know what the economic effects will be." Now, over the last 2 weeks, Powell's colleagues have amplified the message that the era of benign rate cuts, meaning reductions the Fed could justify simply as unwinding its prior tightening, are over, or it's over. Instead, they have signaled the Fed is likely to leave rates where they are until either the labor market shows signs of outright deterioration or inflation declines. And the main argument about that is essentially that the Fed can't really do anything about energy shocks because by the time the Fed acts or the impact of the Fed makes its way through the economy, whatever that issue that shock is probably going to be gone. And so the Fed's tools are not very good for short-term disruptions is basically the argument. And that's sort of what Powell is arguing, is that short-term inflation expectations have changed, but over the long term, if the war ends for whatever reason, that everything should return to normal. There's not this sort of underlying issue. As Milton Friedman famously said, inflation is always and everywhere a monetary phenomenon. That's more looking at sort of the long term, because a short-term shock such as a reduction in supply or a jump in demand, which of course is something that we saw with the housing sector, right? You saw this huge jump in demand for housing during COVID, which caused prices to skyrocket. Now, a lot of that, of course, was the COVID spending and people having more money, and so they were able to spend that money to buy those houses. So yes, that was a monetary issue as well. But in this case, this is not an issue of the Fed printing more money. This is an issue, this is a supply shock. And so once that supply shock is over, once supply returns to normal, everything can go back to normal. And it's not the sort of hangover that's going to exist or be sort of persistent in the economy. And so that was welcomed by traders by the fact that we did see rates fall. And so that was some very good news. And then on top of it, it is jobs week, and the economists are expecting some pretty weak data. I think non-farm payroll on Friday is supposed to be around 50,000. Private payroll is around 40,000. Jobless claims are expected to rise slightly, nothing too crazy. And I believe job openings are expected to continue falling. And so all of that would point to a weaker labor market. Now that, along with this idea that this inflationary issue, this short-term issue, is going to stay potentially a short-term issue, is why you saw rates fall today. So that was great news. Now, it was interesting because there was an article by Joseph Sternberg in the Wall Street Journal that I thought was very interesting, talking about the Fed. There was also a good one by Alan Blinder, who is a former Fed board member. And I think he was, right? I think I'm right about that. Yes, he was vice chair of the Federal Reserve from 94 to 96. I knew I was right about that. His was basically about just the perils that the Fed is facing with all of these issues that are going on about Fed independence and the lawsuits and just the craziness there. So it's a good article. But Joseph Sternberg had a very interesting article as well, opinion piece, saying, can the Federal Reserve please shut up? It's not what you think. It's not what you think it is. It's not him like attacking Powell for talking to the press or anything like that. No. What he's saying is that up until the 90s, what the Fed was doing, what the Fed was thinking was somewhat mysterious. I mean, you could kind of read the tea leaves and maybe figure out where they were going. But for the most part, we didn't hear a lot from the Fed. And it wasn't until the 90s, he points out, that this change under Alan Greenspan, as officials began issuing somewhat more explanatory statements alongside their policy announcements. Then we had the financial crisis of 2008, and this was the communication between the Fed and the economy got even greater. Sternberg writes, the Fed has accepted a theory that by guiding everyone's expectations of future inflation and monetary policy, the central bank can affect inflation today. And that, of course, was a big issue in 2008 when things were collapsing, is they wanted to let the markets know that rates were going to stay low at zero for a long time. And so not to freak out and to feel comfortable, borrowing that money and keeping our economy going. Ben Bernanke was particularly advocate for this theory that the Fed communication could serve as a policy lever in its own right, alongside manipulation of short-term interest rates and expansion of Fed's balance sheet. And then the dot plot that you hear everyone talk about, the dots were introduced in 2012 to signal that interest rates would remain low for an extended period of time. And we've kept the dot plot going. And Sternberg's article or argument is basically, let's get rid of the dot plot. Because he says it's been actually more of a negative because, and we've heard this from Fed governors. They're like, we don't like doing this because it does get misinterpreted. And markets interpret the hell out of it. I mean, when they release those dot plots, I mean, it's you watch any show, Bloomberg, CNBC, whatever it is, they're going to be talking about that. That's going to be the bigger issue. Oh, what are they projecting? What do they think is going to happen? And there have been cases like, for example, the last Fed rate cut, where we did see two Fed governors who actually voted for a rate cut, but actually put in their dot plot, their projections, that rates wouldn't move, which many interpreted as sort of a protest. So it's like Powell got them to vote for the cut, but they actually didn't want to do it. And so that was, that's how that was interpreted. And so whether that was a good thing or a bad thing, you can look at it anyway. But Sternberg argues that a lot of like the inflation expectations, they got pretty wrong, with the whole idea of inflation being, what was the term they used? Transitory, and that it was going to go away. And so he's arguing that they're getting a lot of things wrong, and that's actually hurting the Fed because people are like, oh man, here are these, great economists, these people who understand how the economy works, and they're misreading things and they're getting things wrong. And so is that hurting the Fed? Is too much communication actually doing damage to the Fed's image? And I don't know about that. I do want, it is fun to read. I mean, let's face it, as someone who creates content based on economic data, more from the Fed is always better. I mean, it's the gold standard, right? When it comes to understanding what's going to be happening with rates and the economy and everything else. So I do like them. So it's not in my interest for those things to go away, but I wouldn't be against it. If someone said, hey, they're going to get rid of the dot plots, we don't need them anymore, that was sort of a one-time thing, they don't need to continue. I do think, I like Powell's press conferences. I think those are good. I hope those continue with, when Warsh does finally get in there. I like the press con. I do like those. I do like a little bit more explanation in the statement, so I'm not against that. But yeah, they could get rid of some of these things. I don't think it would be the end of the world, and I don't think it would be a bad thing. Now, it could be interpreted as them trying to be more secretive, and with some of these allegations out there about is the Fed getting political or not, that could be an issue. But I wouldn't be against it. But it's a pretty good piece. I'll put it in the show notes. You can check it out. But yeah, two pieces in the Wall Street Journal about the Fed I thought were interesting. And I think they both have their points. I think they're both very interesting. But yeah, it was a good day for rates. Thanks to Jerome Powell. It was all him. I mean, it started before him, but it really took off with his speech at Harvard and sort of solidified the gains that we saw today. All right, before we go, I did want to point this out. Another Wall Street Journal piece. Man, I'm like, what's the point of me having any other subscriptions? There was a piece in the Wall Street Journal about Japan placing a multi-billion-dollar bet on the U.S. housing market. A lot of people worried about the housing market. For more than a decade, Japanese home builders have been tiptoeing into the U.S. housing market with small, discrete acquisitions of private American construction companies. That quiet era is over, writes Rebecca you say that last name? Picciotto? Picciotto? I don't know. I think it's Italian. I'm not reading it correctly. Japanese builders have announced or closed acquisitions of 23 U.S. single-family home builders since 2020, more than double the number from 2013 to 2019. That doesn't include the multifamily developers and construction supply companies that have also bought. By some estimates, Japanese builders are now set to own about 6% of the U.S. home construction market. Now, they also, as I've mentioned many times, Japan is the largest foreign holder of U.S. debt. So it's like the 1980s all over again. They're getting very heavily involved. And why is that? Well, it's because it's a better bet than their own market. So despite the fact that people are worried about the U.S. housing market with higher mortgage rates and a potential ban on institutional builders, institutional investors, from buying homes. Trump wants to ban that. Elizabeth Warren wants to ban that. Probably going to happen, even though it's a small sliver of the actual rental market. That is scaring some investors. Japanese builders are not scared. And they point out for one reason only, our market's better than theirs. The birth rate in Japan has mostly declined every year for the past decade, and the median age continues to grow older. I mean, this is the one thing that I always remind people of when they say, oh, America has these problems, whether it's the national debt, whether it's our economy, whatever it may be. I always tell people, as bad as it is here, we're still better than everyone else. Like, there's a famous quote. I can't remember who it was now. It wasn't Churchill, but it was someone who said something about, well, it would make sense it wouldn't be Churchill because he's talking about but he said something about the U.S. justice system is like the worst system, or maybe it was democracy. It was something along those lines where it's like America's, democracy or justice system is the worst, except when it's compared to every other system that exists. And then it's like, no, actually it is the best. It's like, yeah, in a perfect utopia, ours is the worst. But in every system that's ever been tried, ours is the best. And that's true for our economy. It's like, yeah, we have major problems, right? We got major issues. We're spending way too much money. We have a growing wealth divide, which can cause problems from a economic standpoint. But all these problems everywhere else is like 10 times worse. Like our debt to GDP is nothing compared to Japan's. Like our slowing birth rate, nothing compared to Japan's. If you're worried about debt, like I said, China has more debt than we do. Europe, no economic growth. And so it's like every time we have a problem, it's like, yeah, it would be better if it was this way, but we're still better than everywhere else. And so that's a reminder whenever people talk about, oh no, we got problems in our economy. As long as we're still the best place to park your money, people are going to park their money here. And we're going to benefit from that. Now, we could potentially reach a point of no return. We're clearly not there yet. This highlights that. But it's always important to remember when people are like, oh, man, I'm surprised. So many problems in the housing market. And here you have Japan like doubling down and being like, we're going to invest. Why? Because their housing market's so much worse. So, yeah, things are good. Things are good relative to where places are bad, where things are bad. So it was a good Monday. No doubt about that. Let's hope this optimism continues. Today we're getting housing data as well as consumer confidence, which could be a big deal because that's the one thing they're looking at. We also got retail sales later this week. But today, yeah, we got job openings, consumer confidence. So if we get a dip in consumer confidence, we get a dip in job openings, that could be a sign that that we could see maybe a rate cut later in the year. So we will see. But this is my last show for the week. Just did one. I think it was great. I think it was pretty good. So we'll take it. But you guys enjoy your week. I'll be back here. I know it sucks. I'm going to miss Jobs Week. But the newsletter will still be going out, so you can follow me there. And I don't think I'll be able to do any videos. So follow the newsletter. I'll be updating you on those. And you guys enjoy your week. We'll be back here Monday for another edition of Wilmington Mortgage. And remember, as always, do not wait to buy real estate, and wait.